Hello and welcome to our Forex Trading Podcast. And today we're going to be talking about why so many retail traders end up blowing up their positions. We're going to be covering through the top 6 ways inexperience can ruin your trading account. And finally, we're going to be looking at why risk management is so important in Forex trading.
Let's get started.
So, to get us started,
We're going to be talking about the beginner's trap. And the beginner's trap is essentially the fact that Forex trading feels so damn easy when you first get started. And the question is, why does Forex trading feel so accessible to new traders?
So Forex trading used to be the realm of banks and hedge funds.
But in the last few years, with the advent of smartphones and zero-commission brokers, anyone can download an app, deposit a few $100s, and be up and running in minutes.
So easy a kid could do it.
Seriously, I mean, a lot of the brokers will let you start with as little as $100, and the platforms are designed to be intuitive, so there's no barriers to entry. So it feels like a video game. It feels like anyone can give it a go.
And why do so many new traders think that they can get rich quick by trading Forex?
Because brokers will offer crazy amounts of leverage, up to 500 to 1. So you can control a huge amount of money with just a little bit of cash. So a tiny move in the market can turn into a massive gain.
That sounds like a lot of potential upside.
But what they don't tell you is that leverage is a double-edged sword. And while you can make a lot of money really quickly, you can also lose everything just as fast.
So how does social media make Forex trading look so appealing to newcomers?
Well, the truth is, social media is flooded with traders who are showing off their huge gains, but they rarely ever talk about their losses. So it creates this illusion that everyone is making money.
So the average person scrolling through their feeds would never know how risky it really is.
Exactly. Influencers will promote their courses with a get-rich-quick spin, and people will jump in thinking that they can get rich without understanding the potential downsides.
So, in the spirit of the 6 ways inexperience destroys trading accounts, let's start with the first one. What happens when traders don't use stop losses, and why is that so dangerous?
Not using a stop loss is one of the worst things you can do, because one bad trade can wipe out a huge chunk of your account. Sometimes even the whole thing.
Damn, that's a scary thought.
Instead of cutting their losses when the market moves against them, a lot of traders will just hope that it turns around. But the reality is that accounts that don't use stops lose 3 times more on average than those that do. So the smart move is to always have a stop loss in place, automatically, and stick to it.
So one of the things that we hear a lot of people talk about is the dangers of over-leveraging. So what happens when a trader uses too much leverage and doesn't manage their position sizes?
When people first start trading, they get attracted to the leverage. Brokers will offer them 100 to 1 or 200 to 1. And so they'll take that maximum leverage and they'll trade as much as they can. And a lot of times they'll do it without even thinking about how much they could lose.
So they're basically gambling their whole account on a single trade.
Effectively. And when the market moves against them, they're wiped out. That's why it's always recommended to not risk more than 1 to 2% of your account on any given trade, and to use the broker's position calculator to make sure you have an appropriate position size.
What happens when traders don't have a defined trading plan? Trading without a plan is a bit like
Driving blindfolded. You're relying on hunches and tips. And a lot of the time you're entering trades because you feel lucky, instead of having a clear strategy.
So it's a recipe for disaster.
Exactly. And the most successful traders are the ones who have a written plan where they know their entry, they know their risk, they have a set of rules, they follow them. They're not making decisions based on emotions.
We're going to be moving into the importance of risk management in Forex trading. And the first thing I want to know is, why do you think risk management is so important in Forex trading?
Because Forex is a volatile and a 24/5 market. There are a lot of global factors that can move prices quickly. And without risk management in place, one bad move can wipe out your account.
So, in other words, it's not just about making winning trades.
Exactly. It's about surviving to trade another day. Good risk management keeps your losses in check, helps you control your emotions, helps you stick to a plan, so you're not forced out of the game by a string of losses.
Are the top risk management strategies that every Forex trader should have in their toolkit?
Number 1 is to never risk more than 1 to 2% of your account balance on any one trade. So for example, if you have a $10,000 account, Your maximum loss on a single trade should be $100 to $200.
And how do traders ensure they don't lose more than that?
They use stop losses, so they have a predetermined price where they get out of the trade. And they also use proper position sizing and limiting their leverage so that they don't get wiped out. Diversifying across uncorrelated pairs, having a minimum risk-reward ratio of 1 to 2, monitoring their trades in real time. These are all the things that can really help protect your account in the long run.
So what's the mindset that a trader should have when it comes to risk management?
Successful traders think about survival first. They know that they have to be in the game tomorrow, so they don't take any unnecessary risks today.
So the focus isn't on hitting home runs.
No. The goal is to be consistent, to follow the rules, and to understand that losses are part of the business. So by being disciplined and managing risk properly, you're the one who will be able to stay in the market for the long term. Well, that's it for today. Thanks for tuning in. And remember, trade safe. We'll see you in the next one.